The policy response to COVID-19 in the euro area successfully avoided the mistakes that had been made a decade earlier. But after COVID-19, what is the correct mix and the right framework for fiscal and monetary policy? And is there a solution that is both economically and politically viable? A recent policy insight from the CEPR, written by one of the people who's been intimately involved in policy making for several decades now, and who has also just written a book about the same subject, examines our options. Hello, Marco. Welcome.
Hi, Tim. Nice to be with you.
Now, Marco, in the title of your book, you've been the inside man during a couple of decades of policy in Europe. In this paper, you look back, first of all, and you describe the policy mix trilemma that was created by the Maastricht Treaty. So can you tell us what this trilemma is and how we accidentally came to have it?
Thanks, Tim. Thanks for mentioning the book. Actually, in the book, I was checking. I have 7 trilemmas. So this is and this is an additional one. Economists, at least economists like me, seem to like trilemmas. I mean, there is a classic one that is inescapable in international monetary economics. Is the one of Mandel, which says that you cannot have at the same time independent monetary policies, stable exchange rates, and fixed and free capital mobility. So this is actually the trilemma that is at the basis of the creation of the euro. With that trilemma there, we decided collectively in the Eurozone to give up independent monetary policy, attribute that to the competence of the ECB, and we solved the trilemma through that angle there. Okay, this is a different one, but I think is relatively powerful as well, because as we try to argue in our paper, I think it allows to provide an interpretation of the policy stance, the policy mix throughout the EMU since its very beginning, so 1999 till today. What does the trilemma of the policy mix say is that you cannot have at the same time fiscal rules of the asymmetric type, what we call proscribing, like those of the Stability and Growth Pact, monetary policy constrained by the effective lower bound, so not having room for maneuver or not much room for maneuver, and not having a central fiscal capacity. So that basically the reading throughout the past 2+ decades is how politicians somehow solve the trilemmas through different corners. And this is, I think you can read the history of the policy developments, monetary, fiscal in economic and monetary union, through the different ways in which the trilemma has been addressed.
Yes, going back right to the beginning, right up to the financial crisis, it seems that politicians did a pretty good job of resolving this trilemma. Is that right?
I think it is right with a caveat. And the caveat is a very important one. So how was the trilemma solved in the first 10 years of economic and monetary union? It was the benign period, as you said before, the global financial crisis. There, I think the Stability Pact was implemented. Monetary policy had indeed room for maneuver. There was no question of zero lower bound or effective lower bound, unconventional monetary policies or negative interest rates. So in a sense, the fact that we had room for maneuver on that front there, I think helped a lot and made the central fiscal capacity not necessary at the time. So on the surface, yes, it helped to solve the trilemma.
And can we look back on this as a golden era, a successful era of policy making, or did we just get lucky?
No, and there I think is my caveat with the capital C actually comes in, because what happened then, we create monetary union, we had monetary policy with the ECB, and countries, especially more vulnerable countries, benefited from a convergence bonus. What does it mean? Basically, they saw interest rates actually dropping to the level of the Deutschmark, of the previous Deutschmark. So this gave quite a boost to economic growth on the one hand, and also helped obviously a lot in meeting the fiscal requirements. Because the interest burden on public debt went down, and this created room for maneuver and an automatic improvement in the public accounts, helped also by the relatively robust growth at the time. What was the caveat and the bemol in this is the fact that actually, since growth was relatively robust, member states, euro area members, did not bother too much to do the structural reforms needed in order to underpin potential growth on the one hand, and second, since you had this fall in the interest burden and the automatic impact of automatic stabilizers, embellishing the public accounts, then they did not bother to do the structural consolidation, which would have helped to actually improve in a lasting way the accounts and the budget. So de facto, when the financial crisis hit, so go back to Lehman Brothers in autumn 2008, all of a sudden, this which had remained under the surface during the first 10 years of economic and monetary union came to the fore big time.
Absolutely, because then we go to a period, the next decade is looked back on rather less fondly, it has to be said. You separate in this paper three sub-periods of the monetary fiscal interactions, which are all problematic in their own way. So what are they, and what legacy did they leave coming up to COVID?
The period of the global financial crisis is indeed, we identify three sub-periods there. I mean, the first one was actually a period in which, at the very outset, both monetary and fiscal policies reacted actually pretty strongly to the shock. And I mean, take monetary policy. I think the first reaction of the ECB was actually more expansionary than that of the Fed. Fiscal policy also, the proposal of the Commission was to actually expand collectively fiscal policy by 1.5 points in 2008 going in 2009. So also got, I think, an important boost. So we achieved in the first place what we call in the paper a congruent policy, so a coherent way of both arms of policy making actually working together. This was the first period, but this was actually ended rather abruptly. We declared victory far too soon. So we thought that the worst was over, and both monetary and fiscal policy actually restricted as of 2010. So we enter a period in which, instead of continuing to support the economy, we actually withdrew support. There, I think orthogonally, we were hit by something that one could not foresee, which was the Greek crisis, which came to the fore via discovery of massive fraud on etc. So deficit was expected to be slightly below 3%, went to 16%. So massive fraud, and this led, I think, to an interpretation through fiscal lenses of the crisis, and then led to a fiscal withdrawal, which was, I think, far too soon. So we overburdened monetary policy in that period, and that was, in a sense, we entered then into the third sub-period, which is the one after 2015, when fiscal policy after the austerity period turned broadly neutral, but monetary policy actually was, basically left alone to fight the disinflation and the excessively low inflation. So it was definitely a less glorious period for policy making. We learned a lot nonetheless.
Well, then you had to employ what you learned, obviously, because in 2019 we have the COVID crisis. How has this exposed the limitations of policy based on this Maastricht framework?
I think the trilemma comes back to help us in this. It was clear that the COVID crisis is yet another unforeseeable, almost existential crisis. The fact of not having, in the first place, a central fiscal instrument to respond collectively to a common shock, I think was glaring in terms of a huge institutional gap. I mentioned before the fact that in what tainted the policy response during the global financial crisis and the sovereign debt crisis was this discovery of the faulty accounts for Greece. So there, what happened was reasoning and interpretation related to moral hazard, I think, played a very, very important role. So in a sense, the crisis was seen as, at least in part, self-induced, policy-induced by the wrong policy. Jump to today on COVID, no one can say in earnest that there is an element of moral hazard in this. So I think this helped a lot to put in place a response, which has been Next Generation EU, together with very forceful response by the European Central Bank, which I think helped to respond effectively to COVID. We have just published the autumn forecast of the Commission. Actually, the recovery for the Eurozone is actually considerably brighter than what was foreseen 1.5 years ago.
Being confronted with these limitations and having to respond, and I think that by consensus, the response within the euro area is considered to be a good one, a strong one. Does that then give us a clue about what the next generation framework might be post-COVID?
I think the answer is yes, but with patience. Yes, because I think we have shown that by responding collectively, I think you can actually have an impact which makes the real difference for the economy, for the life of citizens in Europe. And also, and that is the experience that we are having now with Next Generation EU, there is a clear appetite in the markets for Europe, basically. I mean, the issuance of common debt under Next Generation EU in the first place. Before that, and that was actually at the beginning of the COVID crisis, under the SURE program, which is a program to help alleviating labor markets constraints, there has been a huge success, a huge demand of these bonds. This clearly shows that Europe is actually much more than the sum of the individual member states. So I think this is what the response has been. Next Generation EU is a program that is considered to be a one-off, so a large one-off, but one-off nonetheless. So it's not a permanent improvement, a permanent change, but clearly it should the member states implement the programs financed by the EU in a proper way, it can actually point to the future on what to do effectively.
Reading your paper, it does seem that much more fiscal coordination is inevitable. How is this vertical fiscal coordination going to work in practice?
In the logic of the Maastricht Treaty is what in the literature has been called negative coordination. So negative coordination means that there is a prescribing element, I mentioned at the very beginning, so certain things you should not do, but then it doesn't tell you what you should do. So it is of the negative sort. Under normal circumstances, I think that may have a chance to work. There is a question mark on that also, but in normal circumstances that could work. But clearly, when you are under stress, in particular under huge stress, as we have been during the global financial crisis, and now, in a sense, even more under the COVID crisis, this is not enough. Now, I think the jury in economics is out, and it stays out forever. It comes in, then it has to retire again because things change and views change. But there is one element which I think, from my own personal experience, I have been witnessing the work of the European Union, the Eurogroup, the way decision making takes place. It is very, very hard to convince an EU country and a Euro area country to make choices for the sake of others. So for the sake of the well-being of the Euro area as a whole. So if they feel that that is not what in their own domestic national interest. That's why I think approaching the coordination of fiscal policies only via horizontal coordination on national fiscal stances in a separate way is not enough. So that's why in the paper we say that we have to supplement this horizontal view with a vertical coordination, and Next Generation EU has been the response in terms of fiscal capacity, albeit just one-off in the response to COVID. So the response in a vertical way, which has supplemented, I think, very effectively the national fiscal responses.
But outside of a crisis, you're the inside man, you know this, outside of a crisis, is it politically feasible to move in this direction in the euro area?
Look, Tim, people ask me, because of my very long experience, what has been a bit the inspiration for my work over the past 3 decades, actually. And if I have to summarize a bit in a imaginative way, I think my job has been to try desperately to lower the discount rate of politicians. It means basically trying to lengthen their time horizon and not think only about today, tomorrow, or the next elections. So the experience is that, and I think I document that in my book, decisions are made in times of crisis. Jean Monnet said that for Europe since the 1950s. So in times of crisis, the Union operates and responds sometimes very effectively, sometimes only partly effectively, but it moves. Then the difficulty is to move in normal times. So I think the experience now is to capitalize really on the experience of COVID to make sure that what has been done in terms of response is actually, we can draw the lessons for the future. I think we have, I believe, a better chance to make a difference this time and to make the system move, because Next Generation EU has created, I think, an element of trust between the member states, which was absent or largely absent during the financial crisis, where acrimony actually dominated the debate, linked also to the moral hazard issue that I mentioned before. So I think we have to capitalize politically also with this stronger trust between the member states to make sure that we learn from the future. and we respond to that demand of Europe that I mentioned before.
So when it comes to moving policy forward on this, how low is your discount rate? Should this be something that's done quickly, capitalize on the moment, or is it a long-term evolution?
I would say medium term. Medium term, because that element of trust has to be nourished. How do you nourish that? I think you do essentially on the part of the member states, showing that they put their money where their mouth is, and they implement the recovery and resilience plans under Next Generation EU in an effective way. So showing that the biggest beneficiaries, take Italy, take Spain, Portugal, and others, they actually show to the so-called frugals, in inverted commas, that the money coming from the EU and indirectly, clearly coming from these countries is very well spent, and spent in terms of the right investment for the double transition, digital and green, and also to support the structural reforms, which actually would boost growth, potential growth in a sustained way. So in a sense, we come to the having closed the loop and go back to what we did not do fully in the first benign years of economic and monetary union after 1999, and do the structural reforms. I think the structural reforms, accompanied by an element of fairness, which is absolutely essential for that, and also a behavior which show that we use the money also to put debt, public debt, on a downward trajectory, so that we do not have problems of fiscal sustainability looking forward.
Well, good luck in your work in the next few decades. Marco Buti, thank you very much.
Thank you. Thank you, Tim.
For more about Marco's trilemma, then you can read it in the CEPR Policy Insight 113, Euro Area Policy Mix from Horizontal to Vertical Coordination. You can download it using this link. And also, if you're interested in Marco's book, it's called The Man Inside, and it is published by Bocconi University Press. Well, thanks for watching, and we'll see you soon.